So welcome back to this session once again. Let's now continue with the fixed income securities. What are we going to cover in this session now? Number one, significance of fixed income securities. We have understood already. What is fixed income securities? Also, we have understood. We will discuss what are the key terms and features of fixed income securities, types of securities and the financial markets, types of fixed income securities and the bonds, differentiate between the equity and the debt instrument, what are the treasury bills, understand what are the pass-through certificates, PTC, pass-through certificates, security receipts and preference shares, of course, all of us know. How to do the pricing and valuation of bond, that is what we will understand. And I'm sure some of you must have heard this term sometime or the other called dirty price. So, what is dirty price? And friends, I can tell you, invariably, I have seen that you will always have a question whenever you appear for the evaluation exam as to what is dirty price. So, this question is almost kind of fixed every time. So, we will understand what is dirty price and how it is different from clean price. What is current yield and how to calculate it, that is what we will understand. How to calculate yield on treasury bills. The government of India, they issue treasury bills which can be of a denominator of for the period of 14 days, 91 days, 182 days, 364 days. So how to calculate, and please remember the treasury bills do not have a coupon rate. Treasury bills are issued at a discount. So the return for the subscriber to the treasury bills is going to be the difference between the issue price minus the redemption price minus the issue price. So the difference is going to be the return for the subscriber. So how do we calculate the yield on treasury bills? That's what we will understand. What is realized yield or holding period return and how to calculate. This is what is the agenda that we have now. YTM. I'm sure friends you would have heard this term quite often. YTM, yield to maturity, and I have seen many times people have a lot of confusion about as to what is YTM, yield to maturity. We will understand as to what is YTM, and incidentally YTM is same as IRR. So what is YTM is same as IRR. That means what? That means how do you calculate YTM on a fixed income security? You will calculate YTM in respect of a fixed income security in the same way as you will calculate internal rate of return in respect of a project capital expenditure. So we will understand what is that. What are the embedded securities? I'm sure you must have heard of this many times. Embedded securities. So what are those embedded securities? Then we will understand yield to maturity, yield to put option, yield to call option, right? So in case of embedded securities, I can tell you at this point in time what are the embedded security. So embedded security is a security which has an option built into it. So any security which has got an option built into it is referred as embedded security or embedded option, because that option is included in this security. Now what does it mean? Let me also explain at this point in time. So what is embedded security? That means company XYZ is issuing non-convertible debenture with call option and with put option, right? So that means XYZ is issuing non-convertible debenture with put option and with call option. Meaning what? Meaning the company will have a right to redeem these debenture prematurely after expiry of certain period. Likewise, since it also has a put option, that means the subscriber also will have an option to get the money back on these debentures prematurely. So when I say prematurely, that means before the maturity time of these debenture, of course after expiry of certain fixed period which is agreed at the time of issue of the debenture. So that's your embedded security, a security which has got an option built into it is referred as embedded security. So YTM you will calculate in case if you hold this security in which you have invested until the time of its maturity. YTP is what is YTP? Yield to put option. That means what is the return, inbuilt return on this security, assuming that this fixed income security is redeemed by the subscriber prematurely, or in case of call option, what is the yield on this security in case if the company calls these fixed income securities or these debentures for redemption. So that is what it is. What then we'll understand what is spot rate and forward rate, and of course I'm sure all of you must be aware what is pricing or valuation of a bond. Now what is the meaning of pricing or valuation of a bond? That is what we will understand. Friends, please remember at this point in time, so when I say bond or I say debt instrument or I say fixed income securities, please remember these terms are used interchangeably. So it's not that is going to be different from the fixed income securities, which is going to be different from the bond. No, it's not. They all mean the same thing. So bond is an instrument on which you get a fixed return. Debt is an instrument on which you get a fixed return. So ultimately all of them are fixed income securities. Okay. So we will understand how the pricing is done or valuation of a bond is done. Understand relationship between the price of a bond and its discount rate. So discount rate is also known as market rate of interest. So depending on the market rate of interest, value of a bond will undergo a change. How will that happen? We will understand. Then we will understand price behavior of a bond, relationship between YTM, coupon rate and value of a bond, how the yield to maturity and coupon rate and value of a bond are interconnected, how do they impact each other, that is what we will understand. Then we will look at the relationship between the market price, face value, YTM and coupon rate of a bond. So this is what we will understand. What is YTM and bond value relationship, we will understand. Then we will come to bond duration. So we'll understand as to what is bond duration. And again, friends, please pay attention. Again, bond duration is misunderstood sometimes. Bond duration is understood as the tenure of the bond. Now, please remember, if bond duration was to be the tenure of a bond, then why would you call it duration? You will simply call as bond tenure. So remember, bond duration is not same as bond tenure. How these two things are different, that is what we would understand in this session today. What are the factors that would impact duration of a bond? How to compute bond duration with the help of an example? What are the properties of bond duration? Why a bond's term to maturity and duration? And remember, in case of a zero coupon bond, and we will see with the help of an example, in case of a zero coupon bond, the term to maturity and the duration are going to be same. How is that and why is that? We will understand. Then we will understand the modified duration, credit rating, and factors which are considered in credit rating. So all the credit rating companies that we have in this country, they do the credit rating of the corporates. So how do they do the credit rating of those corporates? What factors do they take into account for doing the credit rating of those corporates? So this is what we will discuss as part of this session. Right. So let's look at the key terms and features of fixed income securities. So number one is face value. I think all of us know this. So at any point in time, please feel free to interrupt me if you have a doubt of any of the terms that I am assuming that we already know, and if you have a doubt about it. So face value is clear. Coupon or interest. So remember, in case of fixed income security, there would always be an interest rate or a coupon rate. So interest rate and coupon rate again are used interchangeably. They both mean the same thing. Interest rate can be sometimes, in case of a fixed income security, fixed or floating, and sometimes even can be zero. So the interest rate can also be zero. And when the interest rate in case of a bond is zero, it is known as zero coupon bond. It is also known as deep discounting bond. And why they are called as deep discounted bonds, that is because the bonds which do not have a coupon rate, they are always issued at a very high discounted price. And therefore, as I was telling you in the context of treasury bill, the return for the return for the subscriber is going to be the difference between the redemption value minus the issue price. So that is your zero coupon bond. Issue price, obviously any instrument which is issued has issue price. Coupon frequency, so in case of fixed income securities and in case of bonds, in case of that instrument, please remember interchangeably they are used, so they are same. So every fixed income security will have coupon and it will also have a frequency. So depending on the issuer, the coupon can be monthly, coupon can be quarterly, coupon can be half yearly, coupon can be annually, as the case may be. It also has a maturity date, that means on date on which the fixed income security will be due for redemption. So that is known as maturity date, and the period after which it is going to be matured is referred as tenure, that is the tenure. Fixed income securities, friends, please remember, can be secured, can be unsecured, and I don't think I need to explain that. Then you have something which is known as nominal yield. So what is nominal yield? And then you also have a current yield, and let me tell you this one in time. So what is current yield? Current yield is very simple. Current yield would mean the interest that the coupon on this is security divided by the current price of the security into 100 will give you current yield. And what is nominal yield? Nominal yield is the coupon rate divided by the nominal value of that security into 100 will give you nominal yield. Then you got an indenture. So what is indenture? Indenture is nothing but a contract. So whenever you have fixed income securities being issued by anyone, there has to be a contract, there has to be an agreement which has to encompass all the terms and conditions, obligations of the issuers, rights of the issuers, obligations of the subscribers, rights of the subscribers, and that document is referred as indenture, so that it would contain all the clauses. Then you got a call option and put option, and I'm sure all of you are aware. So call, and of course we will also be discussing call option and put option as part of the option and option valuations. So what is a call option? It's a right. Call option is a right. What is the right? The right is to purchase a particular underlying at a prefixed price on a given date, right? And that is your call option. Remember, options are called options, and all of you please pay attention. Options are called as options because the holder of the option only has a right and no obligation, and that is why they are called as option. That means if I have a call option, I have a right to purchase certain number of shares of company XYZ at a price which is called as strike price. So now I have a right, but I do not have an obligation. Meaning what? Meaning having purchased the call option, if the price of the share has gone up in the market, then I would exercise that option. If the price has gone down below the strike price, then I would simply let that option expire because it doesn't make any sense to me. So I have no obligation. I only have a right. So tomorrow, the person who has sold me the call option, he cannot come and tell me and force me to exercise the option when the price has gone down. And why he cannot force me? Because I only have a right, I do not have an obligation. So that's your call option. Put option. So in case of call option, what do I do? In case of call option, I acquire a right to purchase. In case of put option, I acquire a right to sell. And that is the difference between the call option and put option. The rest of the things are same. That means what? That means if I think Maruti's price is going to go down, if I think Maruti's price is going to go down and I am holding Maruti's share, right? So what can I do to save myself from the likely loss? The one option that I have is to sell the Maruti shares in the market and get my money. And in case if Maruti shares really goes down, I am happy. But what if I sell the shares, shares of Maruti, and contrary to my expectation that the Maruti shares will go down, they don't go down, they go up. So now instead of making a profit, I'm going to earn a loss because I have sold the shares, and therefore I'm going to deprive myself of the benefits of the price going up. So what can I do? I can, instead of selling the Maruti shares in the market, I can purchase a put option. And what is put option? Put option is the right to sell. Meaning what? So I buy a put option to sell Maruti shares at 7,000 rupees, right? And the seller of this option is taking the obligation. What obligation? Obligation that any time when I want to sell these shares to him, he has to essentially purchase these shares of Maruti from me at a price of 7,000. So tomorrow, as per my expectation, the Maruti share price really went down to 6,500. So what will I do? I will exercise my put option, sell these shares to this gentleman, get 7,000 rupees from him for every share that I am selling to him, which we agreed. And the market spot price has gone down to 6,500. So what I would do, I would purchase more shares of Maruti, and that's how I will end up making a profit of 500 rupees. What if the Maruti's price has gone up? Then what do I do? Then I do not have to do anything because I'm holding the shares. Price has gone up. It is in my interest in any case, and I'm under no obligation to sell these shares to the seller of this option to me at 7,000 rupees when the market price has gone to 7,500 rupees. So that's your call option, put option. And as I discussed a little while ago, please remember, whenever a company is issuing the fixed income securities, many times they also issue embedded securities. And what are the embedded securities? Embedded securities would mean that they have built-in call option or put option, as I have explained to you. Then it has got a maturity or redemption value. That means the amount that the company will pay on the redemption to the subscriber of the security, that is known as maturity or the redemption value. So the amount that will be paid by the subscriber will be paid by the issuer of the security to the subscriber or the holder of the security at the time of the redemption is known as redemption value or maturity value. Then you got a YTM. I'm going to discuss with you in detail. YTM, dirty price, I'm going to discuss with you. Clean price also I'm going to discuss with you. And priority in payment. So please remember, fixed income security is a debt instrument. Since it is a debt instrument, the holder of the debt instrument will always have a priority in getting his money before any money is paid to the equity holders. So these, friends, are the key terms and the features of fixed income securities. In case if you have any question, any doubt, please go ahead, else we will go to the next topic.